Hi. Hi, I'm Kevin Jefferson, the People's Lender, NMLS number 1433853. So today's topic is the current state of our real estate market. So in this real estate market, the question that everyone wants to know is, do we buy or do we wait? So in my opinion, I think that we purchase if it makes sense, right? So what does making sense mean? If you are in a situation where your landlord reaches out to you and they say, buyer, I am going to increase your rent by $500, and you're now currently paying $1,800, and that means you'll be paying a $2,300 rent payment, then I would see about getting pre-approved. $2,300 is a mortgage payment, a substantial mortgage payment for, depending on which part of the country you're in. I'm in the Atlanta area. $2,300 a month is probably about $275,000. So in that case, you have the ability to see if you can get pre-approved. If in fact that you're in that situation and your rent is $1,000 to $1,200, and your landlord said they're going up, $200 or $300, in that case, I would potentially stay put. Stay put because you're probably not going to find a property that you can purchase and pay $1,000 to $1,200 in rent. Not in the current climate of this market. Depending on the portion of the country you're in, but always weigh your options. Now, one thing I will say is not to wait until you're 2 months out or 3 months out from your lease being renewed. I would take advantage of knowing when my lease is up, and I would take that time and speak to a mortgage professional to see if I can get qualified, and if I can get pre-approved. If I can get pre-approved, then how much and what does that payment look like? What type of loan is it? How much do I need to bring for down payment? How much do I need to bring for closing costs? Those are the type of things that you need to understand and to know in advance. Far too often right now, people are waiting until the last minute, and then they're either having to rush to settle for something, or they have to re-sign their lease simply because they are in a position where they don't have enough time to purchase a home, because the time frame is not enough. This is a very competitive market. Low inventory, a lot of demand. Buyers are competing against other buyers as well as investors, hedge funds. So it's a very highly competitive market, and you need to make sure you are in a position to put your best foot forward in the beginning at all times. Um, so the next thing we want to talk about is inventory. So inventory, supply versus demand. Right now, we currently have more pre-approved buyers on the market looking for properties than we do homes. So with that being said, the price of housing is constantly increasing. So in this market, what we're seeing is we're seeing three things. We're seeing interest rates increase. We're seeing housing prices increase. But along with the interest rates and the housing prices increase, we also see the rents increasing. So that's where we kind of go back to what I alluded to a while ago, is to seeing what is the best situation should you buy. A lot of people are hedging, because they said we're going to go through a recession. And out of the last 6 recessions, there's only been two housing crises: 1992 and 2008. 2008, the recession came from the housing crisis because all of the different scenarios that was going on in the real estate market, and the housing market crashed. The problem with 2008 versus now, they had too many homes. The supply, they had so many homes available, they were practically giving them away in different parts of the country. So not only were there new construction homes that builders couldn't finish or finished and couldn't sell, there also was a supply of foreclosures that came on the market. And at that point, there weren't enough buyers to supply to fulfill that demand. This market is different. We have so many buyers that we don't have enough people we don't have enough homes for people to fulfill it. So, do I think that we're going to see foreclosures? In any market, there's foreclosures. When the market was at its peak, when the market was at its worst, you're going to see foreclosures because people are going to go through different situations to get foreclosed on. So what you have to do, you're competing, and you have to be in position to have your own funds, typically. Now, there are some down payment assistance programs, but right now, if you need anything above 21 to 30 days, you're probably not getting your offer accepted. So the demand for housing is high. A lot of that goes to the increasing prices of rent. If rental prices are up, people are saying, if I'm going to pay $2,300 a month, I'm going to try to buy. Now, them looking at trying to buy and having the money to put down for down payment and closing costs will determine their ability to purchase. They may be able to afford a $2,300 a month payment. However, can they afford to bring the amount of money that they need for down payment and closing costs? Which also spins into another subtopic: interest rates. Right now, we're seeing interest rates as high as they've been since 2008. And what that means is that when interest rates increase, your buying power decreases depending upon when you were pre-approved. So if you were pre-approved in March of 2022 and interest rates were 3.25%, and then all of a sudden April of 2022, interest rates increased to 5.25%. That had an effect on your pre-approval amount. Unless you got a raise in that time to offset the increased interest rates, your pre-approval amount could have potentially went from 250 down to 230 or 225 simply because of rising interest rates. Rising interest rates are a factor of the market, and part of it is trying to slow down the market so we won't have to head into a recession. Now, when I got into the business in 2004, interest rates were somewhere around 7%. And at 7%, when they dropped into the sixes, people thought that they were stealing money because interest rates were at an all-time low at that point. What happened was in 2020, when coronavirus pandemic hit and interest rates started to go down, we saw all-time lows for interest rates. However, a lot of people sat on the sideline and decided, hey, there's going to be a wave of foreclosures coming because the government has issued a forbearance, and some of these people aren't going to be able to work it out. They were expecting people to have job losses, and they thought there was supposed to be a wave of foreclosures coming on the market so they could get a property for pennies on the dollar. However, the opposite happened. Interest rates doubled, and housing prices increased around 37%. So with that being said, those people that were sitting on the sideline who could have potentially gotten pre-approved now may not even be pre-approved for enough to purchase a home, and they definitely aren't pre-approved for the same amount they were back in 2020 or 2021, just because of the increase in interest rates. So interest rates have a huge effect on it. It's not the end all be all. You know, you can get into a situation where your interest rates are a little higher right now. You might be looking at like 6%. However, there's going to be a time where interest rates go down. So if interest rates go back down, that's where you refinance, you get the lower interest rate. Depending on the type of financing, that could decrease your mortgage payment. So if you have FHA financing and you have enough equity in your property and you refinance, you could potentially go into conventional financing and get rid of your mortgage insurance. And with your interest rate being lower, you will then have the ability to have a lower payment. Cool. So not the other part with the rising interest rates is discount points. So discount points is what it costs to get that interest rate. When rates were low, let's say a few months ago, 3-4 months ago, when rates were lower 3-4 months ago, the cost to get that 3.25% may not have cost you anything, or it may have cost you one discount point. A discount point is 1% of the loan amount. So if the loan amount was $200,000, discount point was 1%, you'd be looking at $2,000 to get the 3.25 interest rate. I'm not quoting you rates. I'm just educating you on the process and how rates are done. So now what we're looking at is interest rates at 6%, but not only is it 6% interest rates, the discount points are now 2.5%. Now the discount points are based off of the sales price, the loan amount, based off the loan amount, but it also depends upon your credit score. So if you have two people that are looking to get a property that's 250, one has a 580 credit score, one has a 640 credit score, you both have the ability to get a 6% interest rate. However, the person with the 580 credit score, the interest rate is going to be more. The discount points are going to be more for them than it is the person with the 640, because the lower score has a higher risk. So discount points are also based off of risk factors. The lower score, yes, we can qualify you, but the likelihood of you with a 580 credit score and you going into foreclosure is more likely to happen than a person who has a 640. So it's risk versus reward. They're going to reward you with a house, but you're also a risk to them. So they're going to charge you more to get that 6% interest rate. Now, typically, the higher the rate, the lower the amount of discount points you pay. And in reverse, the lower the rate, the higher amount of discount points you pay. Doesn't matter at 620, you get a decent rate. 640 is a good pointer, but after 740, your rate remains the same. And while we're talking about rates, government-backed loans have better interest rates than conventional financing. So if you have an opportunity and you can qualify for FHA or conventional, and you can get a 6% conventional, your interest rate is probably going to be slightly higher than 6% 6% FHA. Your interest rate is going to be slightly higher with conventional. So that's another determining factor you need to check into. Rents. So as we talked about earlier, rent pricing is steadily increasing. A lot of it has to do with supply and demand. There's a great demand for housing. In certain parts of the country, in metropolitan areas, people are moving to those areas and landlords can ask for more. They can ask for more because they understand there's a low supply. So rental prices are increasing. A person moving from New York to Atlanta in a one bedroom studio apartment in New York may be $3,300, and for $2,500 they can move to Atlanta and get a 3 bedroom, 2 bath house on its own land. So landlords have the ability right now to increase rents, and then not only that, with housing pricing increasing, there are investors who are buying at the top of the market, and to make sure that they cover their mortgage and as well as their expenses and making a profit, they're adding more onto it. There's also some landlords who have been landlords for a period of time and their rents were at market or below market. Now they're taking the time now and increasing the rent amounts, so the monthly rental payments, so that they can make more of a profit on it. So increasing rents is a factor in this market as well. And simply because they can ask for it and they're probably going to get it, because if a person may be able to afford a $2,500 a month mortgage, but they don't have the money for down payment and closing costs, then they can go rent. Now, something about rents, typically they want you to make 3 times the amount of rent. So with that being said, if rent is $2,000, you need to make at least $6,000 a month to even qualify. That's before they look at your credit score, your eviction history. So all of those things come into play, where mortgages, they calculate it differently. How much does Mr. and Mrs. Buyer bring in on a monthly basis? How much does Mr. and Mrs. Buyer have going out on a monthly basis? And in a lot of cases, they don't have to have $6,000 a month to qualify for the mortgage. So that's where you go, reach out to a lender, and you work on getting pre-approval. Now, with a pre-approval, you would call a lender, such as myself, and I'm going to ask you a series of questions. My questions is going to be, have you filed bankruptcy or been foreclosed in the last 7 years? Do you currently have a job? What's your employment situation? Are you a W-2 employee? Or are you self-employed or 1099? If you're self-employed or 1099, I'm going to ask you about tax returns. Have you done your tax returns in the last 2 years? Then I'm going to ask you, do you have any money set aside for down payment or closing costs? That's going to be key, because you can have the score, you can have the income, but if you don't have the money, then you're not going to be able to qualify. Now, there's different ways that you can come up with the money for the down payment and closing costs, and we'll get into that a little bit later. So once I ask all those questions, I'm going to send you a link to my online application, and it's got a secure portal where you or the lender, they should have a secure portal to where you can upload your documents. Most lenders are going to require you to have your last 30 days of pay stubs, most recent, meaning the last 2 pay stubs you got. If you get paid 2 times a month, if you get paid 4 times a month, the most recent 4. If you get paid once a month, your most recent. If you're in June, you can't give a lender your pay stubs from March, because you may have had an increase in income, you may have a decrease in income, you may not even work in that same job. So you have to give most recent documents. The next thing you're going to have to give is your most recent 2 months of bank statements. That preferably the one that has the money in it, and definitely the bank statement where you have your direct deposits go in. After that, we need your 2 most recent W-2s and or 1099s for all jobs that you worked in the last 2 years. So if you had 3 jobs in the last 2 years, you need to provide all W-2s for those 3 jobs. If you've done the same thing with 1099, we need all 1099s for those last 3 jobs for the last 2 years. Next thing, if you're self-employed, then we're going to ask for your last 2 years of tax returns, all pages, all schedules. We're also going to ask for a copy of your driver's license to make sure you are who you say you are. We want to make sure that Mr. Jones is Mr. Jones applying for a loan and it's not someone else applying in Mr. Jones's name. We'll also need a copy of your Social Security card. If you can't find your Social Security card, we can take a copy of your passport. Those are the most important documents in the whole equation, because that allows for us to see if you in fact can qualify. Those are your financial picture. We pull credit, we analyze those documents, and we make sure that once we analyze those documents, it lets us know how much you can qualify for, if you qualify, or if you need to increase your score or decrease debt. So once you're pre-approved, and a part of the pre-approval process is, do you have the down payment that's required for the loan? If your lender tells you that you're pre-approved for a loan of $200,000 and you're utilizing FHA, you need a 3.5% down payment. If you're using conventional, your down payment can be as low as 3%. If you're a first-time home buyer, and if you're a repeat home buyer, it's going to be as low as 5%. If you're a veteran and you want to utilize your VA benefits and you have your certificate of eligibility, your down payment is most likely going to be 0. And if you're in a rural area, hopefully I said that right, rural area, you can utilize a loan called USDA, and USDA has a 0% down payment. And that's key. The down payment is different than closing costs. The down payment is utilized to pay down on the home, and closing costs is utilized to close on the home. When you combine the two, it's called cash to close, meaning your down payment and your closing costs combined is cash to close. Now, what closing costs takes care of? Closing costs takes care of paying the attorney's fees, taxes, homeowners insurance, escrows for taxes and homeowners insurance that goes to the lender, a title insurance policy for the lender and the buyer. And what the title insurance policy does is the attorney's office does a title search for like back to 60 years, and they're human and they make mistakes, right? So if they make a mistake, the title insurance covers you if there was an error that was done and someone was due funds. The title insurance policy covers that for you as well as the lender. So that's protection for you and the lender in case an error was made with title. Taxes, the taxes that get paid to the city or the county. Homeowners insurance. When you purchase, you need 1 year of homeowners insurance paid in advance, because every month, a 12th of your yearly homeowner insurance amount is escrowed with your mortgage company, which means if you pay $100 a month for homeowners insurance, $100 a month of your mortgage payment, the homeowner insurance is included in, and then they take that $100, set into an escrow account along with taxes. And when that bill comes due in a year, the mortgage company then pays the homeowner's insurance and the taxes so that they're not late. Yes, we all like to think we're good with money. However, I find it advantageous, and you have to if you utilize FHA, and in most loans, you have to escrow those things, because what happened back in the day, people were paying their mortgage, they didn't pay taxes, didn't pay insurance, they lost their house to fire or it got tax sale, and then the mortgage company loses out. By them having control of you paying it a 12th every month, and then when that bill's due, the mortgage company sending it out to the town or the county and then send it to the insurance agency, that ensures them that those items are being taken care of, and that's one less risk they run into those bills not being paid and them losing out on the mortgage. So To wrap everything up, we went over, the housing market, the current state of the housing market. We also went over, what a down payment is, what closing cost is. We discussed the supply and demand for the current rental market, as well as going over the rental market. Not the rental market, interest rates, how interest rates are affecting your mortgage, and along with increasing interest rates, increased closing costs because of discount points. If you found this information to be helpful or you have any questions, you feel free to comment below. Give me a thumbs up if the information was helpful. And if you like this information, please subscribe to my channel. I'm Kevin Jefferson, the People's Lender. Have a great night.